Hello. So today we have a fun video. We're going to be looking at SOFI stock. And I say this is fun because I've had a lot of people asking me about this stock and talking about it. And right now it seems like it's all the rage. Everyone thinks it's the next best thing next to sliced bread. So let's see if that's the case or not. So SOFI, if you don't know, it's public banking for people. Mainly they make their money off of loans. It's kind of getting into that financial commerce sector of everything. Something that's very expanding with high yield savings accounts and personal loan offers for people. So they're tapping in that market and they're kind of working on that. So let's look at a chart of their price history. Down 4% today. That's nothing to brag about. So we'll just look past that. Down 1.63% over a week. Up 39% in a month. Up 92.68% in 3 months. Year to date, 40%. 1 year, 177. 5 years, 91. And we can look at the max too for that. So it seems like they IPO'd back in November of 2020 at $11. And spoiler alert, this is really close to actually what they're valued at, in my opinion. So IPOs are a good place to look at because people are really actually doing valuations at that time, the initial public offering. And it's a good indicator of maybe where the stock price should be around. And of course, things change in every stock, but it is a great baseline to look at. So $11, great to look at first. And you'll see it skyrocketed all the way up to, let's see here, $25. And it bottomed out at $4. Seems like people are really pessimistic on it in 2022. Would have been a great time to buy because now they're at $22. So you see these wild price fluctuations all over the place. It hasn't even been 5 years. So a lot going out to stock, and you can see the optimism has just gone up and up in the last 2 years. So let's see if that is warranted or not. I don't own any of SOFI, and I do these valuations to see if I should own SOFI. So what I look at with all these numbers would be what drives my decision to make a stock purchase or sell if I owned it. So we can look at some of the news here, just get a guideline of where they're moving. People are making predictions on this left and right. SOFI and Paychex are teaming up. SoFi is trying to tap into the kind of like private market, get it with employers and try to help their employees, kind of offer those personalized loans and banking solutions to employees. So that's cool to see. If they're breaking into that could be good for growth of 50% in a month. Everyone's asking if it's a buy or not. You see a lot with this partnering up. They're trying to get in the private market. Mixed option sentiment from SOFI Technologies is up 2%. So a lot going on. The main thing right now, people are trying to evaluate it. It's like trying to catch a falling knife, In my opinion, it's like trying to catch a falling knife. Is it good or is it not? I'm going to say it's already overvalued, but let's get into numbers and look at this and see why. Now, getting into the actual analysis, we're going to be in our studio just to make sure we can plot and work with the numbers correctly. And you can see that I brought a lot of metrics into play here to kind of take evaluation. We got revenue, and we're going to look at growth and differences, operating expenses, operating income from that. EPS, free cash flow, and then price of sales. A lot of metrics, net income. So it's very important that these are numbers we're looking at because this is how you properly evaluate a company based on discounted cash flows. You need the cash flows and then you get it from the financial statements. And then there's other metrics that you can look at that determine company health. So going with this, we'll see. And let's run this, make sure it's all running great. So we got a couple charts here. This first one, at the top left we can look at, we'll see that black is the revenue line, the maroon color is operating expenses, operating income is the bright green, and then net income is the blue. So what are we seeing as trends? Revenue is going up, we want to see that. But along with revenue going up, we have seen operating expenses going up linearly in correlation with it. So you want to see revenue outpacing operating expenses so your margins grow. Operating income, which is this light green, we see that it's gone from negative to positive. That's great. You see that a lot with startups. Initially, they're not going to be profitable. They're trying to get to that market share so that they can become profitable and work at scale. Now, we have this blue line, which is net income, and that should be in line with operating income. But you'll see some of these spikes, mainly because a lot of the time, SOFI was running at a loss, so then they get some of that tax money back later in the year. And I mean, you can see that little spike right here. That's from that. So they're really profitable out of nowhere. It's because they got a refund. We look at the deposits. This is their whole intention. So right down here, this black line, they want to grow customer deposits. The more deposits you have, the better, because that's what you make your profit off of. And additionally, when people are already on your app in your ecosystem, they're more likely to try other financial products that you have to offer them. That's the whole case with Robinhood that I always talk about. Now, if we look at this dark green line over here, this forest green, we'll see that this is their free cash flow. This is what truly matters. Okay, so you have your revenue, you have your operating income, net income, and then free cash flow is at the very bottom. This is after everything what you're bringing home. This is pure profit. That's the way I like to describe it. You can see they don't have it. So for 2 years, and this correlates quite well with when the stock was going down, from 2021 to 2023, their free cash flow was absolutely tanking. Multiple reasons. I mean, maybe their margins weren't there. More likely, they were just very, very bullish and putting all their money in advertising because they want to gain the customers. You can see during that time period that the deposits just continued to go up and up. So they succeeded in that. So it's not necessarily a waste of money. Even if your free cash flow tanks because you're trying your butt off to get market share, it's not a loss if you get that market share. So again, none of these things in their own right say one way or the other. A lot of the numbers are working against each other, so it can be difficult with a company like this. It's not, yeah, it's great. Every number here seems great, or every number here seems bad. Things are working against each other, and that makes it difficult to evaluate a company and if it's a good buy or not. And in these cases, it makes me a little hesitant because you want to see either all good or all bad. You know, if you want to make a determined decision on either way of the stock, when you have a mixed opinion, it becomes very difficult because you need to see where the stock's at. So these charts are very telling. And now when we run these, we got a couple things here we're looking at. So we're going to be looking at growth of all these metrics. On this top left chart, we got revenue growth in black and operating expense growth in red. So as I was saying, revenue was going up, but so was operating expenses. What we want to see is that revenue is growing quarter over quarter, or we could look at year over year, but all these numbers are quarter over quarter. We want to say that revenue is growing faster than operating expenses, because if it isn't, say operating expenses is growing faster than revenue, your costs are going to catch up to your revenue. You don't want that because that just is going to diminish your profit, and if it stays that way, you won't be profitable. Okay, so let's look at what's going on here. We want to see that this black line is trailing over the maroon, and we can see that it is. There's times where it was mixed, especially in the beginning, and we saw a lot of that pessimism in the stock price, but overall they've maintained that their revenue growth is faster than their operating expenses. And obviously we don't want to see revenue growth going below 0%. We want to see that it's increasing, and overall it has been. And operating expenses have also stayed above 0, which it kind of happens. When you're growing a company, of course your expenses are going to grow. That's nothing surprisable. But they've maintained it in a decent way. So that's good to see. And now we can look at the difference of these two lines. How much faster is revenue growth growing than operating expense growth? So it's just revenue growth minus operating expense growth. So we want to see that this is positive, above 0. That means revenue is growing faster than their expenses. And for most of the time, it is. That's what we were talking about, that the black line seems to be above the maroon. There's obviously times where it's not, especially if you look in 2024, between 2024 and 2025, they're struggling a little bit. They had a pullback. But during that pessimism time of the stock, you can see why that's happening, because operating expenses were growing very fast. And people don't like to see that because that squeezes your margins. When your margins are squeezed, you're not profitable. And companies, especially startups, need to be profitable. And now if we look at operating income growth, again, this is like general profitability, what we're looking at. We see that this is growing greatly. So these numbers are very difficult because they'll have one quarter with one number and then the next quarter with a wildly swinging number. So it's very difficult. It's not like something like when we evaluate Home Depot, very nice numbers to look at because they're an established company with consistent incomes. Yeah, SOFI is very different. So this was a unique experience for me. And now let's look at here. We have a EPS, and this is diluted. So that's important. So SOFI has been issuing new shares of stock, and that's horrible for the investors because it means you have less piece of the pie. You're entitled to less, basically. So when you issue more stocks, your EPS is going to continue to get diluted, and that's earnings per share. You want good earnings per share because that means they're making good money in proportion to the amount of investors. So when your EPS is going down, that's bad. But you see it's been coming up, but it's barely positive, which isn't good because you barely have any money to split among your investors. So again, the pullback, and you can see this is time during pessimism. We had a lot of things working against it, but they've been coming back. So you can see why maybe people are getting a little more excited about it. And now, let's see, we got the revenue growth is this green line, and the black dash line is a 3/4 trailing average. So you can see revenue growth staying above 0. That's what we want to see. But also the moving average gives us a better idea what this is looking like, and they're kind of flattening out 8 to 9% if you're looking at a 3-month average. So that's kind of how we would determine the growth rate for their current period, because they're a new company. We want to see how fast they're growing. But they did have some high quarter over quarters, which you can see, which are almost up to 12, 13%. So all these numbers are quarter over quarter. We're going to be looking at an annual basis when we're evaluating it. So keep in mind about an 8% quarter over quarter. So we'll work with that. It's a decent number for now. And now this, we're just going to run this little bit of code and we can mess with the valuation of it. Now let's see if we can, yeah, okay. So we got SOFI we're working with. Their most recent, and this is in millions. So I think this would be about 2.64 billion annual revenue. Let's say they grow at 25% for the next 5 years. I think that's pretty fair assumption. We talked about 8%. We'll mess with this number, but I think 25% growth rate over 5 years is fair, considering we would expect this to slow down their growth that they've been seeing recently. And then a long-term growth rate of 10% over 10 years. I think that's still fair considering they're a newer company. And then after that, say they grow 3%, and that's just inflation, basically. Big gripe I have with this evaluation is that we're assuming they have a 10% free cash flow margin. That's not true. We saw they barely have any free cash flow, but just assume that they figure out how to make the 10%. They can squeeze those numbers out. Let's just say they get there, and then we discount it at 10% because that's average S&P return. Basically, you can mess with that number. And currently, we got to change this. They have 1.1 billion shares outstanding. So let's run this DCF model. Okay, so when we run it, we'll see a couple metrics up here. So discounted cash flow values this at 14.33 billion market cap based on all these numbers. If you take all the cash flows and bring them back today, this is what it's going to be. So this implies a share price of $13. As we were talking about earlier, and as you can see now, the share price is not $13. At least the number I was importing during this a couple days ago was $21.16. That's overvalued by $8.13, which is 38.42%. So, that's a little concerning. And I said that the IPO number was very accurate, and it was. It was $11, and we're saying it's 13. You know, things got a little more optimistic since then. That's cool for a company, but it's not as optimistic as $21. Just, we're not quite there. So we can mess with some of these numbers. We saw like an 8% quarter over quarter. So let's assume that and let's just do a simple multiplication, times that by 4. No, that's not how it works, but let's just do it. This would bring the stock price to $16.90. And this is I think a very aggressive growth rate. I don't think the growth they've had is sustainable for the next 5 years, but what do I know, right? And this will put a stock price of $16.90, meaning it's overvalued by $4.26, which is 20% overvalued still. So it's not looking the best. Let's say after those 5 years, maybe they can pull off something like 13% growth rate. Okay, well then you're getting close. But even then, that's like break even. And we want to see that it's undervalued, right? Otherwise, there's not really a market to buy this stock. In my opinion, looking at these numbers, there isn't a market to buy SOFI. Simply, the investors are getting a little overexcited. They're getting ahead of themselves. And I mean, what do I know? SOFI could really just bring it home, get a home run, and just crush earnings left and right and center and just keep growing and growing. But from what I'm seeing, that's really unrealistic, and I want to bet on things that are realistic. I don't want to guess that they have to do this crazy thing and that crazy thing. And then it feels like I'm investing in Tesla, and that's why I don't do it. I think SOFI is very similar in that case. Investor expectations are super high, and in my opinion, they're unrealistic. So I don't quite think we can make it there. So that's my evaluation. Now let's look at a place like Morningstar and what they would say. Right before we get into Morningstar's evaluation, let's look at a couple things that Robinhood offers us. We can see trading trends first. Looking at Robinhood, we can see that there's been a lot of net buy activity recently. Yeah, I don't know. It's been kind of a lot over the place, but a lot of net buying. I'm sure if we looked farther back, that we'd probably see even more net buying, considering the stock has just been going up like crazy. Look at hedge funds, a lot of net selling. That's something to keep in mind in Q4 2024. Look at that, 100% sell rate, 100% sell rate in Q1 2025. So hedge funds are really bearish on it, if that tells you anything, because a lot of educated investors there, and we can see that in Q1 2024 they were actually, quite optimistic. Insiders, that gives us some insight too. We can see that in December we had a lot of sells, sell, some buys here, sell, sell. So we can kind of see the general trend here. There's a lot of selling going on. There's a lot of selling going on between hedge funds besides insiders, and there's a decent amount of buying activity on Robinhood users. So that tells you that, smart money, educated investors, right, they're trying to pull out a SOFI position, and retail investors are trying to buy into it. And that's a story we see a lot, and sometimes it works out for retail investors. In my opinion, I don't think it will this time. I think, what goes up has come down in this case. So if we look at Morningstar's valuation, and they're going to do it very similar in the way that I did it, but they'll have their own metrics. I said, to be fair, it's at $13. I think that's fair value. They said $14. A couple things here. They give it 2 out of 5 rating. That's not good. We don't like to see that. Economic moat, what makes them different than their competitors? None, which I would agree with. There's nothing that really diversifies SOFI. It makes you want SOFI over somewhere else. I mean, I'm in some of these products, and I didn't choose SOFI. Why did I choose SOFI? I didn't have a reason to bring me there. Uncertainty, very high. I think that's great. I mean, we saw in the past stock chart that prices were all over the place. People were trying to evaluate it right now. Some things are going on with the company, and we saw in the past your metrics were a little tough. You're all over the place. You don't know. And stewardship, standard, that's just their balance sheet. Standard, I'm pretty sure that's what you'd about expect for a lot of these companies, especially if it's a newer company. So no gripes with that. I think that's very fair. I think Morningstar made a pretty good reasoning with this, and you can always read into the report, see how they specifically got down with it. But again, it's going to follow that general trend of how I evaluated it. I think SoFi is incredibly overvalued right now. I think it's a great company. Let me say that. I think they do some really good branding. They have great advertising, and they've been taking a lot of market share. As we saw, their deposits have been just steadily increasing, and that's what they want to do. So they're doing great in all those aspects. They're a great company. They're overvalued. And those two things can be true at the same time. SoFi is a great company. They're overvalued. Tesla, pretty good company, maybe great, overvalued. Apple, great company, probably fair valued. Google, great company, probably fair valued. A lot of these things. There's a lot of great companies that are valued at low prices. And those are the ones you want. You don't want a great company valued too high. You don't want a great company valued right at where it should be. So, in my opinion, I would say, for me, I'm not interested in buying SoFi. I think with these financials, I don't have what I want in front of me to make a buying decision on it. So, I'm going to stay away for now. If price came down significantly, knowing what I know, I could easily change my model to address their price differences, and I would love to do that. Say the price came down to $8, $7, I'm looking at it 100%. But at $21.03 today, I'm simply not interested. So thank you guys for watching. I want to do more of these stock reviews. I really love this. This was a lot of fun today. And I'm going to at least try to do one every single month. I already have my monthly upload I want to continue doing. And now we're going to try to add a stock every single month. So we're slowly introducing more and more content to the page, and we're going to continue doing that. Thank you for watching. Share with your friends, leave a like, comment. Any questions? If you have a stock you want me to look at, drop in the comments, because I see what I see. I don't see what other people see. So I would love to look at what other people want to see and report that back out. So thank you and take care.